Emerging markets has a very diverse consumer base. Some of the countries are less affected with tariff and less affected with economic activities. You still see low employment rate and still decent growth. Other markets like China, Mexico, you are seeing more impact on the employment. So with the consumption sector, what we are seeing is structural growth is still in place despite the tariff uncertainty.
Welcome to Well Said, discussions with Wellington management, investment, and research professionals about market, macro, and geopolitical dynamics affecting investor outcomes now and into the future. I'm your host, Thomas Mucha, Wellington's geopolitical strategist and member of the firm's global macro team. Since early this year, when the first shots in the global trade war were fired by the Trump administration, emerging markets have taken off. Now, as of this recording, the MSCI Emerging Markets Index is outperforming both the MSCI All-Country World and the S&P 500. Why is this? Well, tariff uncertainty has weakened the U.S. dollar, stabilized inflation in some developing countries, and it's renewed global investor interest across emerging markets. And while no EM conversation is complete without China, the story here is decidedly broader. So joining me to discuss the EM investment and geopolitical environments is an in-house expert and a returning guest, Meunier. Bo is a portfolio manager on our EM equities team and a respected veteran of the firm. Bo, it's great to have you back on Well Said.
Thank you, Thomas. Great to be here.
Now, Bo, of course, emerging markets are many markets with different cultures, different characteristics, different industries, and of course, different relationships to the U.S. and China. They're also home to companies that are vital to the global supply chains of several key industries, including a number of critical sectors that we talk so much about on this podcast as they relate to great power competition and other geopolitical dynamics. So I'd like to start, Bo, with your thoughts on EM contributions to some of these sectors, and then maybe we can drill down to regional markets. So let's start with a very top-of-mind industry, artificial intelligence and related AI infrastructure boom. How is the role of companies across emerging markets evolving in the AI space?
Emerging markets play a very critical role in AI industry development, both on the hardware side as well as on the software side. On the hardware side, almost 75% of global market share of semiconductor memory products are produced by emerging market companies. So those are a key part of the supply chain in the AI industry.
The Trump administration says it wants to do more onshore manufacturing, including, as you say, the most strategic of sectors, semiconductors. Bo, you've been to semiconductor fabrication plants in Taiwan, Malaysia, South Korea. Given these experiences, given your knowledge of the industry, how realistic do you think it is for the U.S. to disintermediate these EM leaders, especially in such a big critical part of where this industry is going?
So onshoring is definitely a trend, but we're not sure how meaningful and how fast the trend would be. If you look at the magnitude of change, most of the supply chains will still remain in where they are. It is an extremely capital-intensive industry. Scale does matter. On top of that, the supply of skilled laborers, the manufacturing techniques, and the rest of the supply chain proximity also play a key role in this. And even though U.S. is the largest end user on single country basis, the rest of factors are not here. When we talk to Taiwan semiconductor companies, fabless companies, they're definitely adding capacity in the U.S. But what they are seeing is the cost is twice as much as what they produce in Taiwan. So someone has to bear that cost.
Who's going to bear that higher cost?
I think it will be shared across some of the end users who are willing to pay up for the leading technology will be paying for premium. Some of the U.S. reimbursement for the manufacturing in Taiwan, some of the U.S. subsidy for Taiwan semiconductor companies in terms of manufacturing here would help to reduce that cost.
So this strategic decoupling across semiconductors, we're talking years, decades. What's your view on what this ultimately looks like?
I would say years. It could potentially be decades. This is definitely an area that other countries, using China as an example, is not willing to give up. China is definitely lagging U.S. Semiconductor capabilities from the start, but they have been investing a lot more in the area, both on the hardware as well as the software side. With the political uncertainty, what we're seeing is actually the investment desire in China has increased, if anything, and that will come not from the tail end of the supply chain, but from the equipment that's used for manufacturing chips, as well as the whole manufacturing process. The whole supply chain China is trying to replicate. Is it generating return that's commercially viable? Not there yet, but it's of such a strategic importance for China. We're seeing a lot more dollar continue to be put in. And as an equity investor, we are also seeing some of the opportunities along that increased supply chain and capex as well.
It's clearly strategic for every country involved, particularly the U.S. and China. Has there been anything from the Trump administration in the policy world, particularly around semiconductors, that has surprised you or the companies that you follow?
In terms of surprise from the current policy, I would say limiting the advanced equipment to China makes sense. But I think that came a little later because you basically a lot of Chinese companies to be able to build up inventory both on the equipment front as well as on the chips front. When we talked to a lot of the Chinese data center cloud service providers, the companies who are training their AI, they all say that they have a decent data center to use. A lot of that is based on the GPUs they were able to pile up before the restriction. So that would be probably one surprise. And the second one would also be the Chinese companies' ability to stack a lot of the data center chips in order to generate function. That surprise is more in China's speed in adopting AI. So without the good hardware, they were able to catch up a lot more on the software front, on the application, on training front. So that's one thing I would say China is doing much better than probably people giving them benefit of. Of course, with the DeepSeek announcement earlier this year, people are able to get a peek of what's really going on in the AI world in China. But even back 7-8 years ago, when we were talking to companies, both public and private, that is an area they're investing a lot more. China always have a lot of data, public and private data. People are more open to new applications and less concerned with privacy. So those broader factors make the application side of AI a lot more user-friendly and developer-friendly. So I think that's what will likely help China to win.
I'd like to switch to another sector in which EMs are critical. That's automotive. As a native Detroiter, I'm personally aware of this phenomenon. I've been growing up with this my whole life. So Mexico, Brazil, India, and other countries are key not only for the auto parts production, but also for raw materials like lithium and cobalt. So again, Bo, I'm wondering about the long-term prospects here for EM auto-related industries, including, of course, the effects of tariffs.
EM companies play a critical part of the auto supply chain, and that goes from the mechanical parts to the OEM. But more importantly, EM companies in general have been playing a lot of the leading role in R&D spending for the next generation. So we can talk about not just the ICEs, but if you think about EVs, and more importantly, the recent smartification of autos, EM companies in Korea, in China, are all playing a key role. And the supply of some of the key material, tariff on auto is still uncertain. We'll have more clarity on auto down the road. Let's start with the traditional ICE. Korean automakers are gaining market share globally as well as in the U.S. So with the tariff, what are the Korean companies doing is, since U.S. is an important part of their sales, they have been adding additional capacity in the U.S. So that's what one type of response in terms of tariff is. If U.S. is a critical market, you add capacity here.
Which is one of the things that the Trump administration is trying to enact.
Exactly. So that is effective. But then there's another part of the auto industry, if you think about China. If we think about the electric vehicle, China is becoming a much bigger player of the electric cars. And U.S., for historical regulation reason, has not been a large market for China. So in this particular case, with the tariff, Chinese companies are basically staying away from the U.S. market and manufacturing in certain other markets, which benefit, for example, Central Europe, Latin America, where the manufacturing base is, both on the production front as well as some of their targeted sales down the road.
Perhaps an unintended consequence of the Trump tariff policy?
Yeah, it's basically pushing some of those companies away.
Beyond the role of EM firms in global markets, I'd like to ask you about the growth in domestic markets. You've alluded to that already. The first thing I think of is the consumer, of course. Many EMs have a growing middle class, more spending power. We're seeing shifts in consumption patterns and the like. So from your perspective, how is consumer behavior, especially in the current global macro environment, affecting domestically focused companies across EMs? What kind of opportunities is that presenting for you?
Emerging markets has a very diverse consumer base. Some of the countries are less affected with tariff and less affected with economic activities. You still see low employment rate and still decent growth. Other markets like China, Mexico, you are seeing more impact on the employment. So with the consumption sector, what we are seeing is structural growth is still in place despite the tariff uncertainty. And what do I mean by structural growth? For example, the shift from offline to online has already happened in the U.S., but with a weak infrastructure of existing offline retailers, we're seeing more of the shift into online in the emerging markets. So it's a trend that is still continuing. We're seeing that in Brazil, we're seeing that in India, we're seeing that in Korea continuously. And strong leaders in those markets are still gaining not only market share, but also unit economics. So that's definitely one area, is the structure shift. Another one would be new services provided. Using China as an example, when young people's unemployment rate is high, we saw the development of online entertainment industry. A lot more users, but also they're willing to pay. And that is a behavior change different versus 20 years ago. So you get companies with higher ARPU, with a higher volume increase, and as a result of that, gaining returns from the developing of the consumer.
But you are seeing a lot of differentiation across the board in terms of consumer behavior on a country-by-country basis?
I would say that the behavior change is more based on the channel change. So, for example, the shipment into lower price items, more value for money, was something that we saw in China. In India, right now, we're going through a slight weakness in the consumer demand. So also consumers are scaling back some of the discretionary spending. So definitely we're seeing different opportunities. On top of that, some of the countries with election cycles, which impact the job market, we're also seeing slight weakness there as well.
So you have to know all these countries pretty intently.
Yes, we do have a team of analysts who are spending a lot of time kicking the tires to identify what is happening on the ground.
It's a big world.
It is, yeah.
All right, but what about real estate? Obviously, the Chinese real estate sector has been a significant drag on that economy. But what about other countries? With interest rates and inflation fairly steady, what's your take on real estate and construction, for that matter, across EMs?
Similar to consumer, real estate is also a very local market. What we have identified are some of the opportunities that's very unique. If you think about in the Middle East, the number of business licenses, for example, in Abu Dhabi and Dubai, has increased from 50,000 5 years earlier to over 150,000 recently. So that means it's a lot more population inflow, a lot more business formation, a much stronger demand for real estate on the commercial as well as residential front. So we were able to identify companies that have land bank that supply to that increase in demand. In Mexico, there are a lot of industrial warehouses, industrial companies that have built up facilities there with the tariff uncertainty. So the money has been spent, but leasing activity is much slower. Utilization rate is lower. So this is a case where you could see asset utilization improving, return improving, and stocks are trading at very cheap valuation. So that's why we find attractive opportunities there as well. And if you think about India, again, in major cities, the supply market has consolidated. So with limited supply and steady growth in terms of business formation and consumer demand, we're also seeing a pickup in occupancy, pickup utilization. I guess I can't talk about real estate without mentioning China. That is a market where we're seeing residential market remains weak, but at the second derivative basis, slowing down is more manageable. So it's not as bad as a few years ago in terms of pricing correction. On the commercial front, that market remains to be weak.
I'm picking up on the theme of differentiation across your entire book here, Bo. Let's spend a couple of minutes apiece. I'm going to dig down into some of the largest EMs, both from a top-down and bottom-up perspective. So again, let's go back to China. In your view, Bo, what's happening or what's most important from a policy standpoint? And what should investors know about the current investment environment in China?
We'll start with the top-down side. The geopolitical risks that you've been highlighting for many years still remain in place, and that's unfortunately is not getting better. But what we are seeing in terms of change in policy will be the domestic policy. China is becoming more focused on economic activities, more focused on supporting the local business, and that is a very important policy shift. So that is one major change that I would say even 2 years ago, last year, we did not get a sense of. Is policy becoming more supportive of economic activity.
What do you think is driving that? Some of the external pressures from the Trump administration? Is it internal structural problems in the Chinese economy? We've already talked about real estate. Is it demographics? What do you think is driving a lot of that?
I would say it's a combination both, because I think structurally we know China is coming to a stage with demographics, with real estate slowing down, a slower run rate compared to before. So it's already slowing growth environment. On top of that, with the tariff discussion, that's a shock to external demand. Even though export is not a major part of economic activities, it does hire a lot of people. So it's a number that they pay a lot of attention to. And Chinese government has a lot of economic data they keep an eye on. I'm sure the change in policy is because they see the inflection point of how weak things are and the necessity to make changes.
Do you expect this consumer support to continue for quite some time?
Yes, broadly speaking, whether it's a CapEx infrastructure that they still need or consumer trade-in for goods that bringing forward some of the demand. In general, the policy support on consumption will still be in place. But I would say the policy support is not just in consumption, people buying additional cars or buying a new air conditioner. Some of the other policy shift is also related to how people perceive their asset. More than 50% of Chinese household wealth are in real estate. And this is clearly a sector that's not going to grow anymore. And within China, people know that. That's the base case. So where would the money go to? China is a high-saving country. We know there's a lot of deposit at the banking system. The real rates has been coming down steadily, bank deposit. And consumer are looking for an alternative. What we are seeing, a positive development starting this year, is really the increased allocation back to equity market. Equity market allocation is less than 15%. It's compared to real estate, it's a lot smaller. An interesting part of the capital market development is adding Hong Kong to part of the China capital market overall map. What we're seeing, the trend is first with the U.S.-China tariff negotiation and uncertainty on capital market, a lot more U.S.-listed Chinese companies moving back to Hong Kong to do listing. But recently, what we're seeing now is all the leading Chinese companies in Asia market are now doing dual listing in Hong Kong to facilitate their global growth. And the policy that China has been setting is very supportive of this. So Hong Kong can be a beneficiary out of this development on the capital market.
That's interesting. So you started with the top-down perspective here, Bo, and how the government is trying to support various aspects of the economy. What does that mean for someone like you, bottom-up investor who's looking for opportunities? How is that impacting your opportunity set?
So over the past few years, we've been seeing more attractive China opportunities, and they would reflect in a few different areas. First one is capital allocation. China wasn't a good place for capital allocators. People were just spending money on capex and regarding very little for returns. But what we're seeing now for the past 2 years is really increased dividend payout ratio, increased share buybacks, which benefit equity shareholders. We're looking for free cash flow rich companies that are willing to pay back to shareholders. So that's one market. But another one is the innovation that's still ongoing. We talk about EV, talk about the tech. Those are areas that China is spending a lot, both on public and private front, in terms of R&D and investing. Another area will be the healthcare. Licensing out of Chinese drug discovery has becoming more pronounced this year. And this is a market similar to manufacturing goods. China has the human talent, a lot more engineers, a lot more researchers graduate from college each year, has a large domestic market to train or to do the trial exercise. So the time to market is much faster there.
Okay. So obviously a lot of opportunities. I could talk to you for 3 hours about China alone, but I do want to move on to some other EM countries here. You've mentioned Mexico a couple of times. Mexico is interesting to me because it's a key trading partner of both the U.S. and of China. That puts it in a bit of a tricky geopolitical position. Mexico now has a charismatic and pretty pragmatic new leader, Claudia Sheinbaum, who seems to be working well with the Trump administration. So with regard to Mexico, what do you like and what are you more cautious about?
You're absolutely right. Their new leader, Claudia Sheinbaum, has proven to be much more positive, both for domestic and international policies. I was there on the ground in April meeting with companies. Many companies were possibly surprised with the policies that her administration has been introduced. With the tariff uncertainty, I think that is still overhang for Mexico. But we think they could come out as a winner in this tariff negotiation versus people's expectation. Mexico was an early focus for tariff negotiation, and many goods, for example, autos, on the surface level still have a high tariff. But what people may not realize is a lot of the goods sold from Mexico is under the USMCA trade deal. So that's about half of the export. So the effective tariff rate is a lot less. And the negotiation for USMCA is expected to be concluded again next year. And potentially we could see more items being included. So starting with the headline, tariff on Mexico is not exactly what our companies are paying. There's also a practical evidence. What we're seeing is the U.S. import from Mexico actually has increased when we talk to companies. So this is despite the concern that people may have on the tariff. The reason is when we talk to some of the U.S. companies who are operating in Mexico, the labor cost is still much cheaper. The production cost is still much cheaper. So all in, with a reasonable tariff, Mexico remains still competitive. And this is for short term and for long term.
It's interesting because from my perspective, the geopolitical perspective, I see Mexico playing a key role in what the Trump administration is trying to accomplish. And what I hear from them a lot is a fortress North America policy orientation in which Mexico is going to play, along with Canada, a very important part, especially as great power competition intensifies. So it'll be very interesting to see how the U.S.-Mexico trade and economic relationship develops, particularly vis-a-vis China. How do you think about that?
From what we are seeing, Mexican companies are gaining shares from China, from Southeast Asian companies. So this fortification of North America makes a lot of sense. I think what Mexico may have to give up is to make sure that they are not allowing Chinese companies using Mexico as a transit point for export into the U.S. market. So they can prove to be effective in that measure, then genuinely goods produced in Mexico could probably enjoy a attractive tariff price.
Yeah, we'll see how the USMCA plays out. Now, Bo, another interesting and sometimes overlooked EM group is Central Europe. You have mentioned it already today. How are these markets affected by the strategic decoupling between the U.S. and China, as well as by this accelerating reorientation of the global supply chain?
Central Europe is one of the underappreciated beneficiaries of this decoupling. They are the biggest beneficiary of fiscal investment expansion by the European Union, especially if you think about the German infrastructure package. A lot of that could go into Central Europe countries.
Poland in particular?
Exactly, Poland and Hungary. And on top of that, when we think about the supply chain from Asia, using China as an example, Hungary is becoming the European center point for EV production because they are attracting the FDI both from Chinese battery manufacturers, Chinese OEMs, as well as South Korean battery manufacturers. So the FDI from Asian countries into Hungary for the European market has been increasing. So that's another beneficiary in addition to the overall European expansion. If you're using Hungary as an example, it's extremely healthy economy. Unemployment rate is at 4%, salary increase at 9%, and consumption is still going strong.
So good fundamentals as well.
Exactly. Yeah.
All right, Bo, I'd like to wrap up with an overall view of EMs, again, in the context of great power competition, and maybe the potential end of U.S. exceptionalism that we're hearing so much about. Now, if we stay on this geopolitical and policy path that you and I have talked about for years, these dynamics likely mean a structurally weaker U.S. dollar, structurally higher U.S. Treasury yields, maybe in the future. So how are these potential, let's call them paradigm shifts in the global economy, changing the way that you approach investing in emerging markets?
A weaker U.S. dollar historically has been good for the emerging market asset class, both in terms of absolute return as well as a risk premium correction. So when we think about emerging markets, it literally has underperformed the developed market for the past 15 years. It was more pronounced over the past 4 years. As we stand today, the emerging market asset class trading at 13 times forward PE versus 20 times for U.S. So I think a weaker dollar environment could narrow some of that valuation gap, leading to re-rating of the emerging market. A slower U.S. growth in the landscape that you laid out will definitely be negative for the overall demand for emerging market as well. But we are seeing a lot of industries, like we highlighted earlier, the technology innovation, the EV smartification, the consumer online development. A lot of those are structural in nature. We do see, despite a slowdown economically, cyclically, due to the policy that we potentially see, there's still positive underlying structural opportunities that we have. And for our emerging market opportunities, what we want to make sure is we focus on the balance sheet, quality management, because it is a bigger Wild West market compared to the U.S.
Good companies with a structural tailwind behind them, right?
Exactly.
All right, well, Bo, once again, Bo Meunier, portfolio manager on our EM Equities team. Thanks again for joining us on Well Said. It's been great to have you here.
Great. Thank you. Great to be here.
The Well Said podcast is a Wellington Management production. Our producers are Colin Hopkins, Mark Murphy, and Dana Wickstead. Editorial support by Amanda Docherty, Colin Hopkins, and Dana Wickstead. The show is recorded, mixed, and edited by Mark Murphy. Animation support from Rasa Sermonte. Production support from Dave Crow. You can listen to Well Said at wellington.com and at most podcast platforms. Thanks for listening.
All investing involves risk, including potential loss of principal. Past results are not a reliable indicator of future results. Forward-looking statements should not be considered as guarantees or predictions of future events. This material was current as of the publication date. Wellington assumes no duty to update the content in the event that the information changes. This commentary is provided for informational purposes only. It is not research that is required to be prepared in accordance with the legal requirements designed to promote the independence of investment research. It is not subject to any prohibition on dealing ahead of the dissemination of investment research. It should not be viewed as a current or past recommendation and is not intended to constitute investment advice or an offer to sell or the solicitation of an offer to purchase any securities. It does not take into account the investment objectives, financial situation, or needs of any particular person. Wellington Management does not provide legal, tax, or accounting advice. The views expressed are those of the speaker and may not reflect the views of others at Wellington. This recording may not be reproduced or distributed in whole or in part for any purpose without the express written consent of Wellington Management. Please refer to the disclosure section of this podcast for complete details.